I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome to another episode of Operators and Allocators. This is your host, Dylan Marma, and we have an episode today that I've been looking forward to for quite some time. This is someone on the show today that I consider to be a good friend, a mentor, an all-around A player and influence to those in the multifamily community. I've been fortunate to share the stage with him. I've also shared a number of beers over long conversations after sharing the stage with him at events, and ultimately just, really always enjoy spending time with him. So I think we're going to get a lot of value out of today's episode. His resume is quite a mouthful, but I'll do my best to summarize it. He's an ex-pro hockey player. He's a 3-time Olympic human performance coach, a successful entrepreneur, intellectual, practitioner, multifamily expert, having spent the last 13 years building businesses in real estate and exercise science and international level sports, having analyzed over $10 billion in multifamily real estate acquisitions. And today he's the founder and CEO of MREX, the Multifamily Real Estate Exchange, focusing on democratizing and transforming real estate in the United States and worldwide. So without further ado, welcome to the show, Nikolaï.
Thanks a lot, Dylan. How's it going?
I'm doing good. So I want to start off and just ask, I think everyone always wonders this when they hear your bio, right? You came from the sports background, and then it seems like, I would say, sports psychology background to a certain degree, doing coaching for Olympic performers. So how did you make that pivot? Because that seems like you're using a completely different part of your brain going from that into multifamily.
Actually, it's not that big of a pivot because my specialty was biomechanics. So biomechanics is actually mathematics in 3 dimensions with human beings, and a lot of nervous system work as well. So essentially playing around with Excel spreadsheets and analyzing data and doing finance math is quite easy compared to what I was doing before. So properties are not as complex as human beings and biology. So essentially it was my mathematic background that really helped me make that pivot, and also made me want to make that pivot because I'd realized that, in my mid to late 20s, I was on the top of my game in the human performance world, like essentially internationally, going to 3 Olympic games, but realized that I wasn't really enjoying it that much, which is kind of weird because when you're at that level and at such a young age, on such a big stage, you should be really enjoying what you're doing, and I wasn't. So that really brought me to, kind of reflect on why that was happening. And I essentially, just came to the conclusion that human performance and all the education that I got in that world and the experience I had professionally was essentially to kind of help me transition out of my athletic career, because I was aiming to play in the NHL. I got pretty close, had a couple bad injuries, really bad timing, and just kind of, shot short of making it to the NHL. And, when you're a Canadian, number one, the NHL is like, it's bigger than religion and it's bigger than anything. And when you're an elite athlete from a very, very young age, and that's all you dream about and aim to do and put so much into it, there's a lot of studies, you were talking about psychology, there's a lot of studies on how difficult that transition is out of that career. And so I guess I realized that the way that I was able to cope with the transition was to keep on working in that same space, just on the other side of the coin, as a coach, as a specialist, as a professional. And I guess, I've always been someone who's always had the guts to do whatever I want to do in life. So I was like, what I really like doing is I love math, I love finance, but I also love innovating. And I felt like the financial world is already quite evolved, but that the real estate world is lagging behind dramatically. So I figured that I could innovate much more in the real estate world. And, so far after 10 years, I think I've innovated quite a lot, and I'm continuing to try to do so. So that's really keeping me very passionate about real estate.
Quite a story, and I'm sure there's a ton of learning lessons as we dig into that quite a bit. And I know you're working on some innovative projects today, and I'm really looking forward to discussing those in more depth. But starting off with just seeing your childhood dream of getting into the NHL fall apart, how did that impact you psychologically? And looking back today, reflecting on that, do you think your life would look much different had it actually been realized?
Oh, for sure. I think my life would have been much different, but would it have been better? Probably not. Like to be quite honest, I've built quite the life for myself. It's been far from perfect. A lot of ups and downs, which I think is what makes life also quite nice and livable. And you have to strive towards that. But I think my life would have been different. Uh, I wouldn't trade what I have right now and what I've built for a career in the NHL. I think I've probably hit that same NHL performance level in number one in human performance as a chief of human performance, and now I think I've done the same thing in real estate where I've probably hit that NHL level. I definitely consider myself an NHL first line player in the real estate world in multifamily, uh, but I think I can still even get better than that. So yeah, it's how did I deal with that? I mean, psychologically, obviously, it was a very hard thing to accept. It probably took a couple of years, to transition. And well, I mean, essentially, I even built a second career off of the fact that I was having trouble transitioning.
Holding on to it, yeah.
Yeah, holding on to it. But at the same token, uh, what it brought me as a human being, as an entrepreneur, as a real estate investor. I mean, the lessons of pushing yourself, of performing, of never being satisfied with what you're achieving, of appreciating the process and the path that you're on rather than just the goal, and also always maintaining a high level of humility, because hockey players, and especially Canadian hockey players, are very well known to be some of the most down to earth athletes, because it's just kind of ingrained in us and the way we're brought up. So I think that has just served me so well in my professional career. I mean, it's a part of me, right? So
It seems like in real estate, without a doubt, that there's a prerequisite for success of having a certain level of competency on the technical side of it. And in addition to that, it's based business, it's a business of psychology and so on. So as someone that's been a performance coach, you've seen both how the art and the science play into impact to compete at a high level. And as someone that's an educator in the real estate investing world, I'm sure you see that very often. Which do you believe to be most important, and which do you believe is going to take someone the farthest, the art aspect or the science side?
I think the art aspect is essentially what really separates the men from the boys, or the women from the girls. But you can't have the art without the science. So the way I like to look at it is, my father was a jazz musician. I grew up in Los Angeles, actually, even though I'm Canadian. So I'm pretty much half and half, like half Canadian, half American, just because I grew up in the US. I grew up singing the Star Spangled Banner every single morning in class, getting up, hand on your heart. But the thing that I learned from my father in music is that, you have these classical musicians who are the scientists, and they can play like nobody. They've been educated, and they have all those bases down pat. But that doesn't necessarily mean they'll be able to become jazz musicians and hit that artist side of just being in fusion with the music and doing all that. And I think that's what it's like in real estate too. You have to have the scientific base, the mathematical base. If you don't understand underwriting and master underwriting and financial modeling, and I'd go a step further in what I do in real estate financial engineering, which is kind of the epitome of modeling and underwriting. If you don't master that, forget about becoming an artist and hitting that next level that will really bring you up to the next level. And I think if you want to generate what we call Jensen's alpha, if you want to generate alpha and really perform more than the rest of the market and be truly as successful as you can be, well, you have to have that scientific base or that knowledge base. And then on top of that, you can build that artistry, that mastery of, like you said, relationships, of seeing things where other people don't see things. And also, well, you can't just spend your life behind a computer. You have to be with people. Number one, real estate's a contact sport, and it's also a very hands-on sport. It's not like the stock market. It's very hands-on. A property is essentially a company. It's a small company, and there are clients living in that company. Your tenants, and you have a team that are working around that. So you have to be able to kind of navigate those waters and be a really, really good sailor on top of understanding how to build your ship.
What is your take on partnering out? I feel like that gets talked about very often is, oh, if you're a good people person, you should just partner with someone that understands the technical component.
Right.
Do you think that can be advice that leads people to a handicap, or can that limit someone long-term?
I don't see the point in going at it all alone. Quite honestly, I think it's very limiting. And I think all it really shows is that you've not done enough personal development on yourself. Usually why people are afraid to partner with others is they're not really afraid of, everyone says, I'm afraid that guy's going to screw me, or I'm going to get screwed in that partnership or whatnot, or it's going to explode. That's not really what people are afraid of. And this is kind of my psychology background, is what people are afraid of are themselves and how they are going to act or not be able to act in certain and specific situations in their partnership, right? Because a partnership, just like a marriage, in a couple's life, is all about being able to not only manage yourself, but manage yourself in that relationship, and know when to tread lightly, when not to tread lightly, when to give in, when to not give in, and that's something that I think a lot of people have trouble with, is they're not themselves ready for partnership. Because I think the most important lever when we're talking about leverage, because obviously real estate is all about leverage, is partnerships. Like, there's no stronger leverage than that. Forget capital stacks and financing and this and that. The biggest leverage you can find in real estate is partnerships, without a doubt. And whether that is at the syndication level or even a higher, building a PE firm or a hedge fund in real estate, or if you're just at like kind of the smaller kind of joint venture level, I think there's nothing stronger than being able to build a partnership.
No, I love that. I think that's a great way to look at it. And just like with leverage can be a double-sided sword, right? Because
Absolutely.
if you're choosing the wrong partners, that could be your downfall, right?
Right, and you have to be equipped. You have to be equipped to deal with leverage, with financial leverage. If you don't have the finance background and the financial engineering know-with-all to manage the leverage, obviously, like you said, it's a double-edged sword. Same thing with a partnership. If you haven't done the work on yourself, the personal development work on yourself, well, you're not equipped to manage that partnership and both sides of the coin of that partnership.
Right. Completely. So on the show, we focus a lot on, of course, being called operators and allocators. We're focusing on the operators being those that are focusing on day-to-day execution, putting in the sweat, and the allocators being those, of course, that usually work oftentimes equally as hard, but they're focusing more on the big picture decisions, where to deploy time, where to deploy resources and money. So in your experience, right, you've had experience clearly building businesses. I'm sure you've worn both hats plenty of times. Which one do you find yourself wearing most often today?
I'm definitely more of an allocator for sure. I think as the CEO of MREX, as the head of the MREX College as well, and also as the chairman of Shared Work Real Estate Holdings, I'm a visionary. I'm someone who's very macro, very in the clouds, very big picture. I don't consider my strengths to be in the micro and the minute. So I'm good at bringing people together. So obviously I'm much more in the asset or the allocation, if you may, kind of area and direction rather than operating and managing, for sure.
Definitely assume that, just having spent enough time with you and being that you've put so much emphasis on analysis and what goes into that. And I think a lot of big picture, conceptual thinking. And how has that impacted you when you're choosing the people that you're surrounding yourself with?
It's a huge impact because I'm a big proponent of kind of strength-based methodology. So I don't focus on bettering my weaknesses. And I think anyone who tries to work on their weaknesses is a bit of a waste of time. Like if you're a goal scorer in hockey, and I like to use hockey aphorisms, if you are a sniper, snipe like it is your, like it's your, like you were meant to snipe on earth, you know? And same thing, if you're in the army and you're a sniper, you shouldn't be on the front line, you know, in the infantry. You should be a sniper. So that essentially, the way I look at that as you know, someone who comes from teams and building teams and being part of teams is, well, hey, if I'm a sniper, I need someone who can pass me the puck, right? If I'm a sniper in the army, I need a grenadier with me who has the heavy artillery, right? So the way that I build all my partnerships is I'm looking for people whose strengths are my weaknesses, right? And who will be there to watch my blind side, and vice versa. I'm the one with the strengths that they don't have.
Mm-hmm. No, I love that. I think it makes a lot of sense, and I think that's how I think the most successful CEOs often are, right? They're the visionary. They're constantly thinking about the future and where you're heading, and putting yourself alongside those that are executing and building alongside you. I think in line with the end goal is what it's all about.
And you know that you don't have to be like that to be like, let's say if you start your own syndication tomorrow morning and you're the CEO of that syndication, or you know, whatever, you start your own real estate investment company with a couple buddies or contacts. You can be the CEO without being that person. Like you can be an operating CEO, you can be a much more behind the scenes CEO, but the important thing is that you have someone next to you.
You might even be better off in the short term if you're
Right,
focusing on the
right.
execution.
But you need someone with you who can you know, fill that
Right.
role, or who has those strengths for sure.
Right. Completely. So tell us what you're focused on today. Tell us about your vision for MREX and where you plan on going with the company.
Yeah, well, I'm focused, I'd say, pretty much on two things right now. Obviously, MREX was founded as a technology company. The goal was to create essentially an kind of a central hub for real estate investors, where everything's happening for them on that application. So see it as kind of maybe like a Bloomberg terminal, but for real estate investors. So we're pretty far advanced. We've put a lot of money into that, a lot of time. We're in private beta right now. So that should open up in the US probably sometime next year in 2022. And also, building the MREX College, which has been just an amazing success over the last 5 years. I hadn't thought about like building an educational platform in real estate. It just came from, people constantly saying, hey, what you're talking about is so fresh, and, it's so thought provoking. Where can we learn about this stuff? Like, no one's teaching this, right? And when I looked at kind of the market, I looked at, well, you kind of have two ends of the spectrum when it comes to education in the real estate world right now, right? On one end, you have colleges and universities. That's fine if you want to become, if you want to work for like a PE firm, or work on Wall Street, or be an appraiser or whatnot. But if you want to buy apartment buildings, like, you don't really need to go and get a degree in finance or a master's degree in economics. Like, that's not necessarily going to help you become a better investor. It won't hurt you. I don't think it'll hurt you. I think knowledge is always power, and more knowledge, well, then great for you. But, if, let's say, if you're an electrician right now and you decide that you want to start investing in apartment buildings, you're not going back to university to do a degree in finance, right? Or in real estate. And on the other side of the spectrum, there are a lot of these coaching organizations and educational organizations that are very good at, number one, initiating people into real estate, giving them kind of the vast basics of real estate knowledge, and then coaching them in mentorship, and I think there are people doing a great job of this. I mean, common friends of ours, Jake and Gino, Rod Khalif, I'm sure that there are a bunch of other people that are, off the top of the head, who are doing a great job at this. Charles Dobbins in Boston, Brad Sumrock in Texas, and there's a whole bunch of people. But there's a huge gap in between what they're doing and what's being taught in universities. And that's where the MREX College kind of fills that gap. Is we're not competing against coaches and mentors and those programs. That's not what we do. We're not competing against universities. We're bringing a university level education and approach accessible to everyday mom and pop investors, retail investors, syndicators, to help them be better investors. And, since we've been doing that since like 5 years now up here in Canada, because I spend time between Montreal and Miami, I founded this in Montreal. We've already had like 5,000 investors and syndicators come through our doors. Our certificate in real estate financial engineering has just been, it's been an incredible program. It's helped so many people. And, I just want to keep on building that because I think I see the direct impact of that. And it's extremely helpful. So, we've started our expansion to the US. Probably by the end of this year, we'll be offering the certificate in real estate financial engineering in the US in English. And that's essentially what I've been focused on. A little bit on the side, doing a couple of real estate deals myself. We've purchased 35 apartment buildings in the last 15 months. Just as a kind of a side deal for fun. And
Not too bad for a side deal.
Keeping myself busy.
Yeah. It sure sounds like it. And I think it's a really unique point you're talking about how you're filling the gap between a lot of the, there's a lot of, like you said, very successful programs that are all about sort of the execution, moving the needle forwards on things. And then, but
practitionership, right?
And yeah, that's exactly the word I was about to use. I think you someone that strikes me as both the intellectual and the practitioner, right? You're
Absolutely
someone that spends a lot of time reading, investing in themselves, but you also put that to work. And I think that's unique to be on the hybrid side of it. But I think as far as getting a well-balanced education, there's no better way to do it, right? Instead of having to pull from different sources, I found myself, I didn't really learn. For instance, I took CCIM classes, right? Those are all about just more of the book knowledge, right? The analysis by the book.
Very brokerage oriented.
Yeah, very brokerage oriented. You don't learn anything about how do you talk to the brokers or how do you handle putting in your offer, right? What should your strike price be, or how do you handle the due diligence and maintaining control over all the tasks that you have going on at one time, right? Whereas some of the other education may go deeper into that side of things, but they may not go anywhere near as deep when it comes to how to do detailed market analysis and things along those lines, right? So,
I see myself as kind of a bridge, just because I have that educational background and that scientific background, but as well as being a practitioner. So I see myself as kind of the guy who bridges, and we see ourselves as kind of the organization that bridges, the PhD stuff and the institutional stuff with the stuff that's really like boots on the ground. So we're kind of that bridge that brings that all together. And I think it just helps. It's good for everyone because I think, it just makes everyone much better.
Completely. So shifting gears a little bit, we're in somewhat of a crazy market right now. It's a very hot market, and the multifamily world has changed dramatically. Even in my short career, 5 years of being focused on this, we've seen cap rate compression. We've seen shifts in demographics. We've seen, even with COVID more recently, we've seen a new types of shifts taking place. So very interested to hear where you see the opportunity in today's market.
Well, I think number one, I'm gonna posit that the multifamily market fundamentals have surprisingly changed over like the last 10 to 15 years since the great financial crisis in 08, in that there are two major things at play. Number one, multifamily market's always kind of been priced next to the bond market, right? And that's why we use cap rates as a metric for pricing assets in multifamily real estate, because the cap rate, when you think about it, is the opposite of a multiplier, right? Which we use in like PE ratios into the stock market. So the cap rate is a divider, right? It's a percentage because it's based off how we price the bond market. The bond market is priced off yields, which are the opposite of price, right? There's an inverse correlation. As bond yields drop, prices of bonds, are going higher. That's why the yields are dropping. Same thing with the cap rate. As the cap rate drops, that means properties are getting more expensive. Now, after 08 and the restructuring of CMBS and all those bonds that were backed by real estate, up until then, you had all these all these pension funds and hedge funds and sovereign wealth funds who, in their mind, owning mortgage-backed securities was the same thing as real estate. But a lot of these things kind of just disappeared. Kind of like in The Wolf of Wall Street, when Matthew McConaughey is like, talking about like Fugazi, or whatever. Well, everyone realized, oh, geez, a bond backed by real estate is not real estate. It's not the same thing. That can actually disappear. Whereas the real estate won't disappear. It might lose value for a certain while, but that property is not going to disappear. And especially even more so when we're talking about multifamily properties with people in it, like contrary to say homes that were just built and on spec and that were empty forever. These properties are still generating, revenue and rents, even if their occupancy levels are dropping. So that has brought a lot of more people to switch from the bond market to the real estate market. So that's kind of changed the fundamentals because people are not looking at it the same way. It's not so true now that you have the bond market and then, further down the spectrum, you have the real estate market. And the other thing is capital allocation changed a lot on a higher level. And this all has, this kind of looks like, if you have a 24 unit property and you're saying, how does this affect me? Well, it affects you vastly because there's something called a trickle down effect, right? And we all live it. So if you have all these family offices and private equity firms and hedge funds and whatnot, who now after '08, rather than allocating just 8 to 10% of their portfolio to alternative assets, which include real estate, but now they've doubled that to 15 to 20%. You have a lot more money chasing real estate now. Plus, the fixed income kind of vision has changed from bonds to a bit more to real estate. And then that real estate's generating returns on itself and being reinvested into real estate. If you have funds that have like trillions of dollars generating, 10, 15% IRR being reinvested each year, and then that's doubling because of the differentiation of allocation, that puts pressure on yields, on cap rates, increases prices. Now, what all that does and what that says is, where is the opportunity right now? I'd say the opportunity is in properties under 100 units. And that's kind of funny. This is the second time that I've been on a podcast today. I'm going to mention my buddy Chris Jackson, who you know quite well as well. Chris was, I posted on Facebook the other day that I just bought a fourplex that I'm going to convert into, I'm going to tear it down and build a 12-unit property. He's like, kind of joking. He's like, don't go under 100 units. It's like a running gag of like, everyone wants bigger and bigger. And since the Jobs Act in 2012 that opened up Reg D, 506C, everyone's syndicating now, right? And syndication wasn't a word before like 2012. So now everyone and their grandmother is a syndicator, and everyone's a general partner in syndicating, and everyone has, 8,000 gazillion units now on Facebook. I think everyone's competing for those big properties. Everyone's trickling down. Now you have all the syndicators that have trickled up, and everyone's kind of fighting for all those 100 to 1,000 unit properties. I'm a blue ocean strategy kind of dude. I'm like, you know what? That's red ocean. Go to the blue ocean. I want to be the big shark in the blue ocean where there aren't that many sharks. And then you go down to the under the 100 unit and even under 50 unit properties. And who you're competing against now? Mom and pop, Uncle Jack and Auntie Georgia. And now you're competing against them. And if you're coming with, a deep knowledge base, like what we're teaching at the MREX college and what you're picking up at these mentorship and mastermind groups, well, now you have an unfair advantage, which you don't necessarily have in that red ocean. So I think that's where the opportunity lies right now.
No, I love that. And I couldn't agree more. I'm definitely a believer. I follow the sort of the school of thinking that there's been a paradigm shift in the last decade especially on B and C class multifamily, right? I think A class and core multifamily has been there for some time, but I think especially when you look at sort of the value add space, that you're seeing that the returns have went down. I remember when people were seeking 10% plus value add, then 8%, now it's 6%, right? And the reason being is because everyone has increased optimism and confidence, and there's a lot of uncertainty out there in other areas, which has pushed everyone into this space. And like you said, being someone that is blue ocean, or you call yourself contrarian, right? And wanting to find the inefficiency and the real opportunities. A lot of the times that's the same suggestion that I'll have for people that are saying, hey, I can't create wealth with a 6% return in today's environment, right? The people trying to get into the space to become wealthy, they're not wealthy now, and it's going to take them 100 years to be able to get where they want to be with that sort of yield. So they need to find something that maybe requires more sweat equity, but they can more aggressively they can create more aggressive returns through doing so.
But you need a knowledge base to be able to do that. Like I said earlier, we've bought like 30 plus properties in the last 15 months. Like the biggest property was a 12 unit property. Like we're buying up like 5 and 6 units, 8 units, 12 units, like nonstop. And we're doing heavy value add. That's like my strategy personally as an investor. Like I'm taking off my professional real estate hat because I've worked with like family offices and syndicators and REITs, but like personally myself, I'm a heavy value add guy. My business partner is a general contractor. I'm part in the business. We're doing heavy value add stuff and opportunistic stuff. And that's where the real wealth, like if we're talking wealth creation, sweat equity, you need the knowledge to do that. Like for example, I bought a barn on a piece of land, cost me $220,000, cost me maybe 60 to tear it down, cost me maybe another $20,000 in soft costs. I went to the city and I worked with them and I got the planning approved. Now we're building 42 units. So now my piece of land at 42 units, right now appraised value is $1.2 million. It cost me 300. I created within about 9 months, $900,000 in equity, right? Which is out of this world when you think about it. Like, you don't have to do 100 of those deals in your lifetime. You do that like 2 or 3 times and you're set for life. But there's a huge knowledge base needed to be able to do that. And I think that's where people are kind of skimping on their education, and everyone's kind of educating themselves in the same way. Now everyone just wants to learn how to be a syndicator. Yeah, but to be a successful syndicator, you need a whole bunch of other stuff. You need to understand land and zoning laws. You need to understand the politics of like municipal politics. You have to understand financial engineering, and then you can do that type of stuff, and you're not stuck in that kind of, return pegged kind of hole that you're in right now.
Yeah, I completely agree. I think when you look at the best way to make yourself successful as a real estate entrepreneur, you sort of have a fork in the road of either being extremely diligent and patient and waiting for those deals that maybe cross your path once a year that, like you describe, that have massive upside, massive value add. Maybe development can come more frequently. That's not a space I have as much experience in yet, but I think that route you can do tremendously well. And if you're patient enough, it's like Buffett says, you don't have to swing at every pitch, right? You're never going to strike out. So if you can be patient and watch them go by and wait for that one that's really in your sweet spot and take advantage of it, then I think over enough time, you can do extremely well for yourself. And the other route is going for more volume. It's being able to effectively deploy a lot of other people's money and getting some small profit share in return. And it will take a lot of volume to be able to make it, which is why, again, people usually shy away from doing smaller deals, right? And they start kind of going for scale and whatnot, but then it gets more competitive, right? So it's just a matter of determining which one suits you the best.
The problem I think is there's a mismatch sometimes in incentives, right? Because if you want to live off real estate, you don't have any equity right now, you have to syndicate, right? Essentially, you have to be part of a syndication. And the problem is that most people want to syndicate at these high levels and these big properties, but I think a lot of people kind of sweep joint ventures under the carpet too quickly, like kind of hybrid joint venture, kind of small syndications. I mean, let's say if you manage to pay yourself 2.5% on the transactions that you're doing, and you're not putting any money in the deal or very little money, just enough just to say that you have a bit of skin in the game, so your investors are confident in you. Like if you don't have any money and you say, well, I want to be a GP and syndicate, I don't know, like say a 25 unit property, put in $1,000, put in 5, whatever, at least put something in. It's the principle of the thing. Put something in, and you don't need to do you don't have to acquire 150, 250 units a year, 750 units to live off 2.5% of your transactions, right?
Mhm.
You just don't need to. I mean, you could buy $2 million worth of property a year that you're joint venturing or kind of micro syndicating. If you're able to pay yourself a 2.5% fee on those acquisitions, that's $50,000 a year. Say you do $4 million worth of deals. That's 100K you're doing a year. $4 million is, in some cities is like 30 units, 40 units. I mean, you don't have to be syndicating hundreds and thousands of units.
Yeah, I completely agree. And I think that's one thing, having a big focus right now on mobile home communities throughout the country. We mainly in the Southeast for us, but I see that some of these deals have amazing returns, but they're small deals, right?
Yeah.
So when you're raising capital, I'm sitting here looking at this deal. It's $1 million deal. It's an amazing deal, and it's going to be a lot of work. But to take that $1 million deal and turn it to a $2.5 million deal down the road is phenomenal, right? So those kind of deals are out there,
Yeah.
but I think it's very often that investors see less of those kind of deals. As an LP, you see less of those kind of deals because people are oftentimes taking them for themselves. I know
Right.
the one thing we've done to try to mitigate that is going the fund model. So it's less work to kind of prep like a deal package and all that stuff, and we can have some of the small deals in the mix of some bigger deals.
Right, like a blind pool, essentially.
Yeah, exactly. So
the problem with the blind pool is you need people really. The trust level for an LP to invest in a blind pool needs to be much higher, right?
Yes.
Because you're not investing in that one deal. And I love blind pools. I think it's a great idea, but I think there's a steps to make to be able to get to the blind pool area.
Mm-hmm.
And I think the other thing is that these smaller deals, I think they can be very interesting to LPs because you can sell them on the fact that they're getting a bigger piece of that pie, right? Whereas, it's funny, and I think we had this discussion a couple of years back, and I think it was in Atlanta or something. It's like everyone now on Facebook has like 5,000 units. It's crazy. Like, wow, I didn't know there were that many units in the U.S. Like, I probably know like 1,000 people who own 5,000 units, and then you're like, oh, but you're an LP in that property that has 1,000 units, so you essentially own 0.001% of the 1,000 units. You don't have 5,000 units. So, I think that's kind of, I'm getting ahead of myself now, but I think, I think it's important not fall into the trap of the ego, and to bounce off the Warren Buffett analogy. I don't think a real estate investment career is based off just hitting home runs. You don't win ball games by only trying to hit home runs. You got to hit some singles, you got to hit some doubles, you got to hit some triples, you got to steal some bases. If all you're doing is always waiting and never swinging, you'll never strike out. Well, that's not exactly true. I think I'll call Warren Buffett bullshit on that one, because there's something called time. Now, he is how old now? Like 90 something, 100 something, whatever. He's lucky. He's had a really long life. We don't all have that luck. My father died at 67, surprisingly. But even if we do live to 100, there's something called time. We don't have 1,000 years to wait, even though we don't strike out, because we do strike out. We die. We get old and we die. So I think at some point you have to kind of balance that and say, like, okay, I can't just always aim for the fences. Like, you can't just be Barry Bonds. You need to hit some singles and doubles. Cal Ripken had a great career.
Definitely agree with that, right? If you sit on the sidelines for too long, you're not going to learn too, right?
No.
You're not going to know what a good opportunity looks like because you don't have the hands-on experience either.
Right. And you might have an investor come in on a single, and that might be why he invests in your blind pool, because you did a good job on that single.
Yep. And I think the key in that case is just sell a single as a single, sell a double as a double, right? You can't sell a single and wrap it up as a home run and
exactly.
have the investor come back.
Never overpromise, always overdeliver.
And I feel like you have probably a number of these because I've heard you talk about your view on a lot of the platitudes that get thrown around in the real estate investing world. But what is one unpopular opinion that you tend to have?
I don't like high cap rate markets. I prefer to go to lower cap rate markets. I think determining whether you invest in a market or in a property based on the price. So I hate that. I think most investors have not switched from a consumer mindset to an investor mindset, and that they've gotten value investing completely wrong. Because value investing comes from the stock market. It hasn't been very well translated into real estate. And I think people are getting confused and not making the distinction between value and price. Price and value are two different things. I think people are getting that all wrong. The whole cap rate discussion is completely out the window. People don't even know what the hell they're talking about. So I think that's definitely the one that probably gets my blood boiling the most, and that I'm very outgoing about.
What are your thoughts on going into a market that has a higher cap rate with the belief that there's going to be compression?
That can be a good idea, but once again, you're speculating. So I hope you have a lot of data to base that off. Because I think there are a couple of things that are very important. And I gave a webinar on this exact subject yesterday. It's probably available online somewhere. But essentially, you have to keep in mind that usually, in most cases, rents and rent growth are inversely correlated with cap rates. So if you're in a higher cap rate market, usually there's less rent growth and lower rents, right? Now, the cost basis of doing value add doesn't really change. Like if you're in Orlando or you're in Tampa right now, Tampa versus say Cleveland, the cost basis for renovating a 10-unit property, for example, is not very different. Like it might cost you, $800,000 to fully renovate a 10-unit in Cleveland. It might cost you $900 in Tampa, maybe $950 because the economy is a bit more robust, and there's too much demand for the amount of contractors and materials that are there. But the difference between the cap rate and the rents make it way more worth your time to do the Tampa deal, right? Number one. And then the second thing is that if you deconstruct the cap rate and kind of get away from the derivative cap rate, because when people talk about cap rates, usually they're like, price and NOI, that's called a derivative cap rate. You're pulling the cap rate out of the transaction by basing on price and NOI. The true financial cap rate is usually used through a Gordon model, which is R minus G, risk minus growth, right? And when you look at risk minus growth and you plug that data in, the 9% cap rate in Cleveland is the same thing as the 5 in Tampa. You're getting the same value. It's just that it's structured differently because Cleveland doesn't have any growth, has higher systemic risk because it's a less robust economy. But purchasing at a 9 cap in Cleveland and a 5 cap, and I'm using numbers off the top of my head, that's not necessarily the exact numbers, but it's an example. That 9 cap in Cleveland is the same deal as the 5 cap in Tampa. You've purchased the same value. You're just getting it differently. In Cleveland, obviously, you'll get more cash flow because you're discounting the future of the value in Cleveland because it's a less robust economy, right? So I think people have got that all wrong. Like I hear people talking and see all this stuff on Facebook and these articles. I'm like, wow, like no one knows what the hell they're talking about. You guys are all like, not you, like you, the proverbial you guys are all like, you guys are all in the dark. You don't know what the hell you're talking about.
Yeah. Yeah, I hear that very, very often. There's always the price per door arguments.
Oh, geez.
And then
that's a great one. I always like to joke about the price per door. Whenever anyone asks me that, I usually send like a link of like a door for sale at Home Hardware or Home Depot, and I'm like,
I like that.
This is what I think about your price per door. I'm not in the material and lumber
Price
business.
per doors have went up a whole lot then recently, if you're saying
yeah. Hey, lumber is the new Bitcoin, man. I mean,
yeah.
I've got a bunch of wood, around here on my house. I'm thinking about, getting into the wood business.
Love it. We got 2 more questions for you here. In today's market, what do you see as the biggest risks that we face as multifamily investors, and what is your way of hedging against them?
Biggest risk is mismatching of essentially debts. So, we use a lot of leverage in real estate, usually 70 to 85% LTV. And syndicators use even more leverage, or JVs, because most of your equity is coming from partners, which is essentially debt, right? Mm-hmm. No matter how you structure it, it's equity, but it's kind of quasi equity, so it's essentially debt. Now, and I'm not saying interest rates will rise or cap rates will expand. Actually, I'm more of the school of thought that I don't think interest rates will rise that much, and I don't think cap rates will expand. In fact, I even think they might compress for quite a long time. But still, you don't want to get caught if they do. Mm-hmm. So I think the biggest risk is people, what they're doing, investors and syndicators, everyone's doing this underwriting upon acquisition. Like everyone's got all these fancy Excel spreadsheets and they're doing all this modeling when they're buying a property before they buy the property. And then once they've bought the property, they're not modeling anymore. They're not analyzing anymore. So everything's being done ex ante, meaning everyone's modeling and doing kind of their underwriting. And, I use the term financial engineering because I push underwriting and modeling a bit further than most people do. Everyone's doing this ex ante, which is it's a good thing because prior to like 20 years ago, no one was doing it. People were just kind of buying properties off the corner of a table with a napkin, with napkin math. But no one's doing anything ex post, meaning after the acquisition. Like you should be updating your ex ante models and pro formas like at least once a year, ideally twice a year, and really ideally every quarter.
Right, you haven't even driven the car yet or even gotten a feel for what it's like actually doing.
And that way you can, because like projecting future, like IRRs in pro formas are based off of projections, right? We're putting in projected expense growth, rent growth, reversion cap rate, refi interest rates. Now in statistics and forecasting, the further out you're forecasting, the bigger the distribution of errors is possible. So what you want to do is update your forecasts as you get closer to that endpoint, which was say your refi or your reversion cap rate, your disposition of the asset. You should always be updating your model so that you get more and more precise as you get closer, which allows you more time to react, to actually be proactive and not be reactive. And I think that's where people are making the biggest mistake. And, if the shit does hit the fan and inflation does go up and interest rates end up going up, some people will be in a very dire situation. Some very successful syndicators and real estate investors will probably disappear from the face of, at least from the face of Facebook.
I think that's a really good point you bring up there. I think about the technology space often and lean startup and the fluid approach that I think people in the tech world, you probably know better than I would, as far as the way that they approach the day-to-day business and not in responding more so to what's in front of them and changes that are taking place as they take place versus sticking to this rigid pro forma that they wrote 3 years ago of how the business was going to go.
And that's how I teach real estate financial engineering, is I teach it, basing off my scientific background, meaning that everything that you're doing is you're just testing hypotheses, right? So the number one thing that you have to do to test hypotheses is you posit a hypothesis. That's your first model. You let it go into work, you measure, and you retest it and you update it. And that's what investing is you're just constantly testing. So if you're not back testing and you're not updating, well, what are you doing? Like you're going to conferences and having beers and chilling with people and, telling people on Facebook how many thousands of units you have, but you're on a boat that might sink.
Right. Not a good long-term strategy.
No.
Share with us some of the top 3 principles that you live by.
Word is bond. I think that is number one. I think it's something that's been lost in our society. Word is bond. If I shake your hand and tell you if I tell you something, that's it. And I will respect that no matter the amount of contracts we have or don't have. And unfortunately, I think that's been lost a lot. And that's probably why a lot of people are very scared to do partnerships, because a lot of people's words aren't worth shit, essentially. And no matter how many contracts and legalese you can put into it, if someone's word isn't worth anything and they don't have any ethics and they're not principled, well, then it is what it is. It's worth what it's worth. So I think that's number one. Humility, I think, to be constantly, to understand, number one, humility towards the market you're in, towards the amount of knowledge that you actually have. Like, I probably still study and research more than, I'm putting anyone to the test right now who thinks they study and research as much as I do into the multifamily market. I'd love to meet you. Really, I would love to meet you. So I think being a constant, having that humility keeps you as a constant learner, and pushes you to keep on getting better and better. So I think that's probably the second principle. And the third principle is to, not lose sight of the fact that right now is all you got. Like, people are so focused on, retiring and having financial freedom eventually, and hitting, X unit, getting to 1,000 units, and, having $1 million in the bank account, whatnot, and in the meanwhile, everyone's like kind of missing out on now. Like, this, your life is happening now, and this is where it's fun, and this is where it's cool. And, I've hit a lot of those marks, and it doesn't really change much. So if you're not enjoying what you're doing right now to get there, it's all kind of a waste of time.
Love it. I think those are all crucial and something that we can all benefit from focusing on more often. And Nikolaï, where can listeners best connect with you online?
You can connect with me personally on LinkedIn and Facebook, Instagram, quite active on all those platforms. You can connect with the MREX College on Facebook, Instagram, and as of last week, YouTube. We've started our English YouTube channel because obviously a lot of our stuff was in French, being in Canada, but now our US operations have opened up. Our offices in Miami are going to open. So yeah, you can find us pretty much pretty easily on internet. And yeah.
Well, I highly recommend following all of Nikolaï's platforms. I've seen a lot of his articles, the ones in English that have been posted on LinkedIn, and it is some really, really solid content, stuff that is technical and up to date, up to speed on where we are in today's market cycle. So highly encourage you plugging in and following along with the content. Nikolaï, thanks so much for joining us on the show here today. Always a pleasure. I think you dropped a lot of gold nuggets that our listeners can all take away a whole lot from. I know I have a bunch of notes here in front of me. So until next time.
I appreciate it, Dylan. Always a pleasure.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk, and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.